I heard someone say Sensex just hit an all-time high and wondered what the hype was all about or why Dalal Street is called India's Wall Street. This video breaks it all down. Hey everyone, welcome back to the channel. This is part one of our Indian stock market series. Today, we are going back, way back, to understand how India's stock market was born, how it evolved through scams, reforms, and tech revolutions, and why it matters more than ever in 2025. Whether you're a student, investor, or someone just curious about finance, this video will give you the full story. No jargon, just facts. Let's get right into it. Section 1. Before the stock market. India's economic legacy didn't begin with stocks. For centuries, wealth in India was concentrated in land, gold, and trade. Merchants across Gujarat, Rajasthan, and Bengal were already dealing in credit systems like hundi long before Western style banking arrived. But formal equity trading that kicked off during the British rule. By the 1850s and 60s, India saw the rise of joint stock companies, mostly British owned, focused on cotton mills, banking, and railways. This created the need for a structured market to buy and sell ownership of these ventures. Section 2. Under a banyan tree. So, here's the origin story. In 1855, around 22 stockbrokers began meeting regularly under a banyan tree in Mumbai's Horniman Circle. These informal trading sessions laid the groundwork for what would eventually become the Bombay Stock Exchange or BSE in 1875. That makes BSE Asia's oldest stock exchange. Let that sink in. Before Japan and before Hong Kong. And for the next 100 plus years, the BSE was the Indian stock market. There was no NSE or National Stock Exchange, no online trading, just floor traders shouting buy and sell orders in what was called the open outcry system. Dalal Street, named after the Marathi word Dalal, meaning broker, became the beating heart of Indian capitalism. Section 3. How trading worked back then. Picture this, a pre internet world where trading stocks meant physically being on the BSE floor. You'd get a paper share certificate, handwritten contracts, and sometimes wait weeks for settlement. If you bought shares, you'd actually hold the certificate. Lose it. That's your ownership gone. Fraud was rampant. Insider trading was common. Regulations were soft at best. But despite all this, India's equity culture slowly grew, especially during post independence industrialization in the 50s and 60s, when companies like Tata, Birla, and L&T emerged as powerhouses. Section 4. The Turning Point. Harshad Mehta. The early 90s changed everything. India's economy was opening up due to the LPG reforms. LPG stands for liberalization, privatization, and globalization. This kicked off in 1991. But in 1992, the market was hit with its most infamous crisis, the Harshad Mehta scam. Harshad Mehta, a stockbroker, manipulated banking loopholes to funnel over rupees 4,000 crore into stocks, pushing prices up artificially. He became a superstar overnight. Media called him the big bull. But when the scam broke, the market tanked and retail investors were wiped out. It exposed how broken the system was. There was no real time oversight, no audit trails, and no powerful regulator with teeth. That crisis forced a reset, a necessary one too. Section 5. The rise of SEBI. Enter SEBI, the Securities and Exchange Board of India. SEBI was set up in the 1988 but gained statutory power only in 1992, right after the Harshad Mehta scandal. Think of SEBI as India's version of the United States Securities and Exchange Commission, or the SEC. Its job: protect retail investors, prevent fraud, regulate intermediaries like brokers, mutual funds, and investment banks, and most importantly, build trust in the system. SEBI introduced disclosure norms, auditing standards, and later algorithms to flag suspicious trade. Over time, it became one of the most respected regulators in emerging markets. Section 6. NSE enters the game. Also born out of the 90s reform wave was the National Stock Exchange, or NSE, launched in 1992. Unlike BSE's old school flow trading, NSE was built from scratch as a completely electronic exchange. No broker shouting, no delays, just tech driven efficiency. By 1994, NSE launched its equity segment. By 1995, its Nifty 50 index became a benchmark. And by the early 2000s, NSE took over BSE in terms of volume. This rivalry led to better pricing, lower trading cost, and massive tech upgrades across the board. Section 7. The Demat revolution. Still, one problem remained: paper based shares. Back then, fraudsters would forge certificates or lose them to avoid taxes. Settlement took weeks, and share transfers were a bureaucratic mess. So, in 1996, India launched the National Securities Depository Limited, or NSDL, followed by CDSL in 1999. These let people hold shares in dematerialized form, aka Demat accounts. This was huge. Suddenly, anyone with a PAN card and bank account could invest in stocks. You didn't need to live in Mumbai. You didn't need a middleman. It was the true beginning of retail democratization in India's markets. Section 8. Here are some major checkpoints that followed. 2000. Introduction of derivatives, futures and options on NSE. 2004 to 2007. A bull run powered by global capital, FIIs, and India's IT boom. 2008. The global financial crisis. Sensex crashed but recovered quicker than expected. 2010. Mutual funds and SIPs gained mass adoption. 2016. The demonetization plus digital push fueled fintech innovation. And 2020. COVID crash and then the retail boom. Every crash led to stronger reforms. Every boom brought in more people. Section 9. Global context. To put this in perspective, the BSE and the NSE handle more trades daily than most emerging market peers. As of 2024, India ranks in the top 5 stock market globally by market capitalization. Sensex, the BSE's index, and Nifty 50, the NSE's index, are closely tracked by international investors. But the Indian market is still underpenetrated. Only 8 to 10% of Indians invest directly in equities. Compare that to 55% in the United States. That is both a challenge and a huge opportunity. Section 10. Why all of this matters? The Indian stock market isn't just a place to make money. It reflects the economic story of India itself, from colonial trading to a 4 trillion economy, from physical share slips to AI based algorithmic trading, from scams to regulation, exclusion to access. And at the heart of all this are young investors, many of them first generation participants. With better tech, education, and access, India's financial markets are no longer just for the elite, they're for everyone. So, that's the origin story. From banyan trees and bull runs to brokers and blockchain, the Indian stock market has seen it all. In part 2, we'll explore how reforms, fintech, and digital platforms like Zerodha and Grow have changed who invests and how they do it. We'll talk about the rise of retail investors, the SIP revolution, and why India's markets are set for massive growth in the next decade. If you found this helpful, subscribe, drop your questions in the comments, and let's build a financially literate Gen Z movement, one video at a time. Thanks a lot, guys. I'll see you next time.